Ever pondered over the secret behind a trader's intuition to predict potential price movements? Well, the key lies within a powerful tool known as candlestick patterns. Originating from Japan over centuries ago, these patterns are not merely designs, but are reflections of price movements and trader sentiment distilled into charts. Each candlestick is a story of price struggle between buyers and sellers, illustrated through its body and wicks. These patterns come in various forms, each telling a unique tale. For instance, a single candlestick can reflect uncertainty if it has a small body and long wicks, known as a doji. Alternatively, a sequence of 3 declining candlesticks, known as 3 black crows, often indicates a strong bearish trend. Traders meticulously study these patterns, learning to decipher subtle hints about potential market movements. The mastery of candlestick patterns equips traders to make more informed predictions about where the market could head next. It's not just about recognizing but understanding the market psychology that shapes them. This knowledge, coupled with technical analysis tools and market indicators, forms a robust strategy for trading. Achieving proficiency in interpreting these patterns requires practice and patience. It involves not only recognizing the patterns, but also understanding their positioning within the broader market context. So let's illuminate the world of candlestick patterns, unwrapping its components, common types, and how to interpret them effectively. Begin by understanding the components of a candlestick. Picture a candle with a thick body and thin wicks extending from both ends. This simple but powerful image is used in financial markets to represent the volatility and trading dynamics within a specific time frame. Each part of the candlestick holds significant information about market behavior. The body of the candle, traditionally known as the real body, captures the essence of market sentiment by displaying the range between the opening and closing prices during a set period. If the body is filled or colored, it often means the closing price was less than the opening price, indicating a bearish market. Conversely, if the body is empty or a lighter color, it shows that the closing price was above the opening, suggesting a bullish market sentiment. Meanwhile, the wicks or shadows that extend from the top and bottom of the body represent the highs and lows of the price during the session. The upper wick shows how high prices went, while the lower wick shows how low prices dropped, providing insights on the extent of fluctuations and the pressure exerted by buyers and sellers. Understanding these elements is crucial for traders and analysts as they interpret market patterns and make predictions. These visual representations help in identifying trends and potential reversals in the market, making candlestick patterns a fundamental tool in technical analysis. The wicks, or shadows as they are sometimes called, represent the highest and lowest prices reached during a specific time period. Now imagine 2 types of candles, one bullish, the other bearish. Let's dive deeper into their characteristics and significance in the financial markets. A bullish candlestick, often colored green or white, signifies optimism among traders. It tells us that the closing price was higher than the opening price during a specific time period, suggesting a period of buying pressure. This can be seen as a signal of potential upward movement in the market, indicating that investors are willing to pay more for the asset than they were at the opening. Interestingly, the length of the candle also carries information. A longer candle suggests stronger buying enthusiasm, while a shorter candle indicates less intense buying activity. The shadows or wicks at the top and bottom of the candle provide additional insights. A short upper wick in a bullish candle may signal that buyers were able to maintain control until the end of the session, whereas a long upper wick could suggest that buyers lost some ground to sellers. Conversely, a bearish candlestick, usually painted red or black, tells a different story. It represents a lower closing price than its opening, indicating that selling pressure outweighed buying pressure during the trading period. This could be interpreted as a sign of pessimism in the market, with sellers pushing the price down as they dominate the trading session. Similar to bullish candlesticks, the size and the shape of the bearish candle can provide clues about the strength and duration of selling activity. Analyzing these candlestick patterns helps traders and investors gauge market sentiment and anticipate potential price movements. By understanding the psychological forces behind these patterns, individuals can make more informed decisions about when to buy or sell assets. This intricate dance of green and white, red and black encapsulates the continuous struggle between optimism and pessimism, between bulls and bears. Now, imagine two types of candles, one bullish, the other bearish. A bullish candlestick, often colored green or white, indicates a higher closing price than its opening. Conversely, a bearish candlestick, usually painted red or black, represents a lower closing price than its opening. Moving on, let's explore some common candlestick patterns. First, the doji, a captivating pattern, manifests when the trading session begins and ends at nearly the same price point, typically indicating a period of hesitation or equilibrium between buyers and sellers. This pattern, due to its unique appearance resembling a cross or plus sign, provides insight into market sentiment and potential shifts in direction. Next, we delve into the hammer, a bullish reversal pattern that offers a signal of hope to investors after a bear trend. Its visual representation, a small body at the upper end with a long lower wick, suggests that the selling pressure was initially strong but ultimately overpowered by buying pressure by the end of the session. This formation is usually a clear indicator that the lower prices are attracting buyers, signaling a potential upward momentum. Following the hammer, we encounter the engulfing pattern. This dramatic shift involves two candlesticks, the first with a smaller body followed by a larger one that completely covers or engulfs the first. This pattern can signify a powerful reversal, as it shows an overwhelming force overtaking the previous day's market sentiment, potentially leading to a continued move in the direction of the engulfing candle. As we come across the morning star and evening star patterns, each a trio of candlesticks that together paint a story of reversal. The morning star, appearing after a downtrend, features a small-bodied candle sandwiched between a long bearish candle and a long bullish candle, heralding the rise of buyers. Conversely, the evening star, following an uptrend, consists of a similar setup but predicts a descending shift controlled by sellers. These patterns are considered strong indicators of significant changes in market dynamics. Lastly, the harami, another intriguing two-candle pattern where the body of the second candle is completely contained within the body of the first. This pattern often emerges at the end of a pronounced trend and suggests a consolidation phase, possibly leading to a reversal. The smaller second candle shows a decrease in momentum, and such a pregnant appearance can be a precursor to a shift in the ongoing trend, indicating that the previous trend is losing its strength and may soon give way to new forces. In conclusion, these candlestick patterns not only serve as critical tools for traders to assess market conditions, but also significantly aid in decision-making by providing visual cues about changes in market dynamics. As we've seen, each pattern has a specific formation and interpretation that, when understood and applied correctly, can be incredibly powerful in predicting future market movements. Lastly, the harami, a two-candle pattern, where the second candle's body is contained within the first, also indicates a possible reversal. Interpreting these candlestick patterns is an art. Traders combine them with other technical indicators and analysis techniques to make informed trading decisions. Remember, these patterns can hint at potential trend reversals, continuation patterns, or market indecision. However, they are not standalone tools. They work best when part of a comprehensive trading strategy, combined with other forms of analysis and risk management techniques. To summarize, today's journey took us through the basics of candlestick patterns and their trading significance. It's crucial to remember that mastering these patterns requires practice. So, spend time honing your skills and familiarizing yourself with different patterns. Apply what you've learned, experiment with strategies, and continue your journey toward becoming a proficient trader. Thank you for tuning in today. Show your support by hitting the like button, leaving a comment, and subscribing for more valuable insights and trading tips. Until next time, happy trading!